Okay, guys. So I'm gonna start. I'll be admitting people that are joining now. But I just wanted to say thank you for joining us today. My name's Joseph Green, and I'm a sales director at the RepTrak company. I'm also chairman of the PRCA's business development group. So I just want to say thank you for joining us on our first virtual event. Delightful to have you here. Just a little bit of housekeeping before we get going. If you've got any questions, you can note them in the comment or the chat box below. And if we don't have time to get to your questions, we'll be able to answer them in post. So as you can see from my screen, sorry, a few people are just joining now. But as you can see, so I've got all the information on the screen. If you want to email me, my email is jgreen@reptrak.com, or if you want to tweet about the event, you can use the hashtag RepTrak or PRCA Business Development Group. It's quite a long one, so let us know how that goes. But I just wanted to say thank you firstly to Casper for joining us. Now, Casper is the Chief Strategic Officer at the RepTrak company. And not only that, he's also one of the co-founders of the RepTrak company. So basically, Casper's responsible for designing and implementing the strategy for the RepTrak company globally. And Casper's played a leading role in the development of the RepTrak company. And just to give you a bit of an overview, over the years, Casper's guided companies across 20 industries, 30 different countries on how to measure and manage their reputation. So without further ado, I'm gonna hand over to Casper. And I just wanted to say thank you for joining. And if you missed the intro, if you've got any questions, just write them in the chat box. We'll get to them at the end. And if we don't have time, we will. I'll follow up with you after. Thank you. Over to you, Casper.
Thank you so much. Delighted to be here with you today and seeing your faces on the video around the world, around the country. So delighted that we can make this happen. Just want to check here that sound is good and you can see my slides as well. Good. So as Joe said, if you have any questions or any comments along the way, feel free to chat them in there and I'll see if I can manage to also get them. And as Joe said, I've been working in this space for the past 20 years. So of course we're talking about my favorite topic. So hopefully I'll be able to share that excitement and passion with you over the next 50 minutes or so, and also share some of the work that we've done at the RepTrak company when it comes to reputation overall and driving business value from reputation, but of course also when we double click on reputational risk, because that is a key topic and it's something that we know is on the minds of professionals from the communication space, from the PR space, and from general management. So I put together this overview. First, I want to give a basic introduction to the reputation management area. Why do we care about reputation? How is it driving business value? And how does the world look like today? And why is reputation and reputational risk management more critical now than ever? Then I want to share with you some brand new work that we've done together with the Risk Association, so AMIC in the UK and RIMS in the US. We've done a global study on the challenges of reputational risk management. We're writing a white paper on that. So I wanted to give you the insight from that and basically identify those 5 challenges that we've seen through interviews with companies and professionals around what makes it so difficult to really work with reputation and reputation risk, and how do you actually balance off the upside and the downside risk of reputation and risk management. So I'll walk you through those 5, give you some answers as the way we look at this, which is the RepTrak reputational risk approach, give you some pointers as to how other companies are doing it, and then hopefully giving you some inspiration for how you can apply this to your company at the end. So that's the objective of today, and hopefully you'll find this inspirational. I know every company, of course, is different. Any of you have different experiences, but hopefully we will be able to give you a framework to take with you on your own journey. The world is basically out of balance. People are frustrated and they're taking action. And I think in today's world, we are seeing that who you are as a company and who you are as a leader is more critical now than ever, because there's been a massive power shift happening with people basically taking control of companies' destiny. And with social media and with the 24/7 availability of information, the company's reputation is literally in the hands of 8 billion people around the world. And what happens somewhere in a remote place can actually be on the front page of your leading business or trade magazine tomorrow, impacting how you do business. And that's really the gist of what we call the stakeholder capitalism. So over the last 10 years, we've seen a wave coming from the Warren Buffett saying that it takes 20 years to build a reputation and 5 minutes to destroy it. Remember that old newspaper test that he was famous for saying to all of his CEOs, is saying, if you can't see this, if you don't want to see this on the front page of the newspaper, you should do something different. It's what we today call the stakeholder capitalism. And you have the BlackRock of the world, the largest investor, saying that they expect their CEOs and their companies to have a purpose, clear purpose, which is more than just making money. And you have the Business Roundtable, which is more than 150 CEOs signing up and saying it's not just about the shareholder anymore, it's about the stakeholders. Now, why do they say that? On one level, you could say, well, these are nice people. They want to do good in the world. They want to save the world. But actually, that's not why they're doing it. They're doing it because it's also good business. And I think that's a good thing. I think it's really a way of saying, we know from our work that there is a good balance between doing good for the world, but also doing good for your company. And our purpose has always been to prove that doing and saying the right thing is good business. And intrinsically, we know that if you do good, people will trust you, they will admire you, they want to work with you, they want to say something positive, and they'll help you if you have a crisis. And that's really been the foundation for the work that we're doing. And what we're seeing is that we can now prove it with data. And I think that's really what we're seeing, this wave of working together, because reputation, and I'll define what reputation means, has really become central to your business success and survival. So reputation is actually something that we've been studying for the last 25 years, 23 years. And what we're trying to do at the RepTrak company is link how people perceive you with their willingness to buy your products, to work for you, to say something positive. Because ultimately we know that the company is meant to focus on their own survival and growth. And the good news is that we can actually link doing well with doing good as a business. And that's what we do at the RepTrak company. We help business leaders basically understand how their company is perceived, and that's what the reputation is, how people see them within product and services, within innovation, workplace, ethics, citizenship, leadership, financial performance, and those seven drivers of brand and reputation. We make it tangible and we give it back to the company and the leaders so that they can make the informed decisions. And this was something we started back in the 90s. And it's interesting to just pause a little and think about how fast the world is evolving. Back in the 90s, the question was, does reputation even matter? Right? As long as you make good products, you sell it, you make a lot of money, everyone is happy. That was the old shareholder economy. And the only responsibility of the CEO and the leadership team was just make more money for your shareholders. Now, fast forward to today, where the largest investors in the world are saying it's not about only the shareholder, it's about the stakeholders. And the stakeholders involve, yes, the shareholder, the employees, the local communities, the general public, the regulator, etc. And it's only by having a balanced approach across those stakeholders that you will be able to give the return on investment to your shareholders. So that's what we focus on at the RepTrak company. We have the data to prove it, and that's what I'm happy to share with you today. Some of the data points, because we do believe that for a company to develop the right strategy, you need to have a data-driven approach. So that's what we do. We collect data on reputation, on brand, on ESG, all around the world, and have done that over the past many years. And I think it's fair to say that, and the reason why you're on this call, I assume, is also because you agree that reputation is a hot topic. Right? Reputation is a topic which has the attention these days because it impacts the business. Right? If it was just negative media coverage, bad stories, we don't believe that it would actually get the attention that it does right now. It has the attention right now because it is impacting the business. It is impacting stock price. It is impacting the cost of doing business because the access to capital, how much money you have to pay to borrow money, or even getting a credit, depends on your reputation. Your credit score is linked to reputation. You can see, and we can see, the customer churn is highly impacted by people's perception of you as a company. Employee morale and their willingness to work for you. We're seeing it these days that a lot of people actually opting out of companies who don't deliver on the purpose and the values that they feel are the right ones for them. And reputation has actually killed more CEOs in the last 2 years than anything else, right? CEOs are not getting laid off because of missing financial targets in the same amount that they are being laid off for reputational issues. So reputation is a key driver of business, and it should be managed proactively. Reputation is also part of the company valuation. So if you talk to your CFO, your CEO in the stock market, you will see that intangible assets has, back in the 70s, it was only about 70% of the market value. Today, it's about 80%. So there's a lot of money in your reputation. And we know from our data that the better reputation you have, and when I say reputation, if we asked your customers or your employees, would they trust, admire, and respect you as a company? The more people say yes to that, you can follow the line here. If your customers perceive you to be poor on that, there are still customers who will buy your products. Right? I'm not saying that if you lose your reputation, you're going to lose everything. But in this instance, across companies, across countries, 12% of consumers would still be willing to buy your products, even if they felt that you had a poor reputation. But look what happens. Every time you move up one tier, you're going to see much more willingness to buy your products. And people and companies who have invested in their reputation to have an excellent reputation, 68% of consumers would definitely be willing to buy their products. So reputation drives business. If you improve your reputation, more people will be willing to buy your products. Now, of course, you still have to have good products, good value for money, fair pricing. But assuming that you also have that, your reputation can be the difference for driving growth. But there's a flip side to that, because of course, if you then have a crisis that will hurt your reputation, it will also impact the same willingness to buy your product, work for you. But it's also going to impact cost of doing business. So what you see here is the Volkswagen example. And of course, we all know that the stock price took a hit, executives were laid off, etc. But what's interesting to see is that the credit rating of Volkswagen, actually, they were downgraded. Now, that's an interesting new development, if you will, because now your reputation risk impacts the bottom line of how expensive is it for a Volkswagen to actually do their business. And that's an interesting one in terms of understanding why reputation has a clear impact on your business. So upside, manage reputation well, you get more support. issues, you will actually lose support. So hopefully so far so good of saying, okay, how people perceive us impacts their willingness to support us. And if we have an issue, then we're going to lose that. And that's why reputation is a key driver of business. But there are some unknowns here, and that's really what the challenges are. And that's what we want to look at, is saying, okay, what are the challenges of reputational risk management? Because if it's that simple, then why are companies always and constantly getting into trouble? And what are the things that we want to look at? So we have done a global study in partnership with AMEC in the US, which is the Risk Association for Risk Professionals, and RIMS, which is the equivalent in the US, where we basically interviewed a lot of people working with reputation risk, insurance, and other sides of saying, what are the challenges of taking this intangible asset and trying to actually do a more systematic approach to risk management? The first challenge is an unclear definition of reputation. You know, what is reputation? How do you measure it? What is the difference between your brand, your reputation, ESG? Is it media conversation, or is it perception with stakeholders? Who needs to get into that? So when there is no clear definition of reputation, it is very difficult to actually do reputation risk management, because you don't know, or you don't agree on, what are you measuring, how you're doing. So how do you quantify reputation, and how do you quantify the impact of issues on reputation? That was the first challenge. The second challenge was this whole debate about what is reputational risk. And this is where we get into more a specific discussion about, is reputation an independent risk, or is it a consequential risk? Meaning, in your enterprise risk management grid, do you have one dot called reputation? And that is a dot that's saying we have a risk of losing reputation, and therefore we need to build scenarios around that, and we need to treat the reputation risk as one of the risks. Or is there reputation risks in all of the other dots? Whether you have a product recall, whether you have a sexual harassment case, whether you are seen as not delivering to local communities, in all of the dots you have in your risk management, is it a consequence of that is going to hurt your reputation? So there's a discussion on that, and if you don't have a clear answer to that, then it's going to be difficult for you to actually manage your reputation. The third one is what we call the reputation multiplier. Now, this is an interesting one of saying, if you do your normal enterprise risk management assessment, you will say, how likely is this issue to happen? We will have a fire in our plant, or we will have fraud in our finance department, or we will have whatever the issues are. How likely is it to happen? And how much money will this cost us if it happens? Both in terms of direct costs associated with it, or unintended consequences of, if this happened, then something else will happen. And that's how the enterprise risk management grid is made. And ultimately, all the risks go up. The top 25, they go up on a quarterly level. Then you assign mitigating actions, and you know how much money to spend against a certain risk, because the return on investment saying, if we spend £1 million, pounds, euros, dollars to offset that, that's a good investment, because if it happens, it would have cost us 100 million, where the likelihood is only 22%. So then you can do your modeling. The missing element right now is what we call the reputation multiplier. So you can look at all these dots, but if they were to happen, what would be the reputation impact on that? And I think that's really where a lot of the nuances are. And our claim is that the current enterprise risk management grids are basically reporting it wrong, because you are not able to calculate the specific impact of the issues, meaning you're mapping them wrong, because it's actually risk number 32, because of the reputation multiplier, that's going to kill you. But you didn't catch it because it didn't meet the threshold of likelihood or direct financial impact. So I'll get into all of these specific ones, but that was the third one. The fourth one is a discussion about linking the strategic, forward-looking, next wave thinking around risk with the operational, Okay, but then how do we do this? And then the tactical, what do we do every day? Because of there are different tempos happening, the world is moving faster than many of the companies. People are sucked into the tactical. It gets into crisis management. And we never get to the point where we actually have an overview of saying that this is how we want to manage our strategic risks with this operational structure, and then we can deal with the tactical. We get sucked into the tactical because of the tempo on the outside world. So how do you actually get data to support all three levels so that you can make a strategic plan which is linked to the operational way of doing business, which will then help people on a tactical level every day? And the fifth challenge was really this confusion around who owns reputation, right? Who is the owner of reputation? It's the CEO and the executive team because they make the decisions that impact how we are. No, it's marketing or corporate communication or PR because they own the channels. No, it's the chief risk officer because risk equals money, which equals risk. No, it's the CFO because it's tied to the stock price. No, it's everyone because it's all around, right? Having that conversation is critical, and understanding the ownership and how you actually divide that ownership and responsibility is a key challenge. And when you have the solution for that, that's going to unlock the ability to do that. So those were the 5 challenges we set out to explore. We identified them, and let me actually walk you through one by one, give you our point of view on how this looks, and how hopefully you can take some of this and apply to the work that you're doing. So the first challenge was unclear definition of reputation, right? How do you measure reputation? How do you quantify it? So what is reputation? Reputation is the emotional bond that you have with your stakeholders that will either give you success or failure. For your company and your organization to achieve your business goals, you need support from a number of key stakeholders. You need the consumers and the customers to buy your products. You need the general public to say something positive about you. You need the license to operate from the regulators and the policymakers. You need financial investment from the community, financial community. You need positive coverage from the media, and you need employees to deliver on your strategy. What do they need in return for that? Well, it's fairly simple. They want to be able to trust you as a company that will deliver on the promises that you're making. And that perception of whether or not I can trust, admire, and respect you is your reputation. And there's a fine line between having a strong reputation, because then people will support you, and not having a strong reputation, and then you're going to lose support. So reputation in its core is the emotional reaction that people have towards you as a company. Do I trust, admire, and respect you? We can measure that on a scale from 0 to 100 and show you how strong your reputation is. And it's based on people's perception of you. And that's an important point. I see a lot of companies saying, well, the media conversation equals our reputation. And I want to say that right up front. That's not what reputation is. Reputation is inside the minds of all of your stakeholders. It is whatever they perceive you to be that is your reputation. Media is influencing them, just as your corporate communication or PR or activities are influencing people. But your reputation is whatever is inside the minds of your stakeholders. Now, today there are many different elements to reputation, and I think that's part of the confusion of, I'm sure you've heard about ESG, so environmental social governance. You have all these reports on ESG, everyone is talking about ESG. You have the credit rating companies who are now taking ESG ratings into their credit rating. That's what I showed you with the Volkswagen example. So all of a sudden, the finance people are talking ESG and reputation, but from a credit rating point of view. Then you have the corporate brand valuation. This company is worth this $1 million in terms of their brand. Then you have loyalty, NPS, and you have all these different factors, which is confusing the executive teams inside companies. But what is this? How do we make it all come together? And that's really what we've done with RepTrak. The RepTrak reputation model, which we've developed over the last 20 years, basically puts all of this into one framework, because without one definition of what reputation is, how we can measure it, how we can quantify it, you're not going to be able to manage it, because then you're going to have different models, different matrices, and you're all running after your different things. So RepTrak reputation here is a model by which we use it to measure reputation and thereby quantifying reputation risk. It's based on a notion of there are 7 drivers of reputation. So when people think about your company, they will think about your product and services, so high quality, value for money. They'll think about your innovativeness, so are you innovative, first to market? They'll think about how you treat your people, so is it a good place to work, do you care about your people? They'll think about ethics and governance in terms of are you behaving ethically, are you are you open and transparent? They'll think about your citizenship, do you give back to communities, do you care about the environment? They'll think about leadership, are you well organized, clear vision for the future? And then they'll expect certain things around financial performance. Are you profitable, strong growth prospect? Those are the 7 dimensions that we've seen over the last 20 years that goes on inside the minds of everyone thinking about a company. Now, there are certain dimensions that are more important to some stakeholders than others. Of course, if you're the financial investor community, you care about financial performance, leadership, and governance. If you're an employee, you care about workplace, product and services, and citizenship. If you are a regulator, you care about leadership, citizenship, governance, etc. So the 7 dimensions, of course, matters to different people. There are also differences around the world, but this is the first step of actually being able to manage reputation, is to agree on a framework, because that's the framework that you can then use and apply for your data. So that was number 1, clear definition of reputation. Reputation is whatever happens inside the minds of your stakeholders. It is not what's going on in the media or social media. That's an influencer. And you can quantify reputation on a scale from 0 to 100 by understanding how they perceive you. You can break it into the 7 dimensions to understand which of the 7 dimensions matter most. And that's important when we come later on to quantifying the impact of an issue on your reputation. So keep that in mind. The next challenge was the categorization of reputational risk, right? Isn't it independent on a consequential risk? Now, this was a very interesting conversation and is an ongoing conversation. You could argue, can you even do anything with your reputation? Don't you just have the reputation you deserve based on the way you run your company? Whatever you do will either give you a good reputation, and if you behave badly, then you're going to get a bad reputation, and there's nothing you can do about it. Or is reputation something you can proactively manage by understanding what matters most to your people, and you take that information into account when you make actions? And we definitely believe that reputation is a consequential risk which you can manage. So reputation risk is a negative event that impacts stakeholders' perception and behavior. So what that means is that any events you have, a fire in your factory, a product recall, your CEO being let go, some fraud in your systems, a rogue employee saying something crazy. Those are potential issues, well, those are issues. And the question is, to what extent will they impact your customers, your employees, your other stakeholders, and their perception of your company? So we believe that reputation is a consequential risk, because there is only an impact on your reputation if something else happened. And therefore, when you have your enterprise risk management grid, reputation should not be one dot. There is reputation in all of your dots. And the key question is, how big of an impact would that dot number 32 have on your overall reputation? And that's also what we call the value chain of reputation. So what I'm sharing on my screen here is basically how reputation and the perception of your company impacts your business. So if we start on the right and go backwards, ultimately we're trying to drive the business KPIs. Higher revenue, higher market share, better profitability, more loyalty, more market value. How will we get that? Well, we will get that from having our stakeholders support us, buying more, recommending us to others, giving us the benefit of the doubt in a crisis, saying something positive, investing in us, working for us, recommending to work for the company. Those are the supportive behaviors we need from stakeholders. Now, why would people do that? Well, they would do that if we have a good reputation with them, if they admire, respect us, trust us. if they think we do well on product, innovation, workplace, governance, citizenship, leadership, financial performance. That's the reputation. Now, where do they get that perception from? And this is an important aspect of saying it is perception. It might not be true, but it is how they perceive the company. They might be customers of the company, or they might not. They might work for the company, or they might not. But they will get input from all the different channels. It could be paid media that the company has put out, be earned media that someone is reporting on. It could be their own media, website, communication campaigns, or direct experience. Those are the channels that makes people experience the company and make up their mind of, do I trust, admire, and respect this company? Do I think they do well on the 7 dimensions? If yes, I'm going to behave in a certain way. I'm going to buy their products. I'm going to recommend them. I might invest in their stock, which will then drive up the business KPIs. Now, if something negative happens, it's going to be reported in the same channels. It's going to make me wonder, can I trust this company? I thought I could, but now I can't, which is going to reduce my willingness to support you, which is going to impact your business. So reputation risk is a consequence of something that's happening. And the key question is to identify, if that issue happens, will it impact people's perception of your company or not? And you can have a very negative thing, which is being reported in the news, but if it doesn't matter to me, it's not going to change my perception of the company. Or you can have a small item, which doesn't get a lot of coverage, but it really is important to me. And because I know about that thing, I'm going to completely change my perception of you, and I'm going to stop buying your products. So this is the system by which you can then actually quantify the impact of issues. And that's, from our point of view, how you need to do it, because reputation is the consequence of something else happening. You need to know what perceptual change that has on your key stakeholders. And that's what we do in the RepTrak database. So running this on your own is good, but without the context of other industries around the world, other companies, it's going to be difficult for you to take action from it. So the RepTrak database is really based on that, of saying, let's understand how any change in issues impacts people's perception, so that they can also identify the business impact. And that leads me to the third point, which is, well, how do you quantify the business impact on a certain issue from a reputation point of view? And that's what we call the reputation multiplier. So now that we know what reputation is, we can measure it. We understand that reputation risk is a consequence of something happening. Now the question is, well, if it happens, how bad is it going to be? And that's what we call the reputation multiplier. My claim is, based on what I've seen, is that the current enterprise risk management systems, they simply do not factor in the reputation multiplier because they're not built to do it. So it's you know, of course they're not, because there are two axes. One is the likelihood of this issue to happen, and the other one is the financial cost. So if you have a situation where you're frauding some of your clients, you actually know it, but the fine would be 100 million. And for whatever company you are, if 100 million is still only yellow because there are other issues which are much higher, then that risk, although you know it and you know that there's a fine, it's not going to be a red risk, because even if it happened, the risk and the cost of that direct risk is not high enough for you to actually put a dedicated focus on it. If you ran it through the reputation multiplier, that risk number 32 would be number 1, because it's not just the fine you're going to get for being caught out cheating some of your customers. It is the regulatory impact on you. You're losing your license to operate. Your clients are not going to work for you and be clients with you anymore. And all of that together would have made the cost of this risk much higher. But if you don't have a way of calculating that, you are basically running blind on your enterprise risk management system, and you are basically reporting not accurately which of these has the biggest potential impact on your business. So let's take a look at how you can actually do that. These are 7 potential issues, and the key question is, which of these issues have the highest reputation risk? They're all negative, right? You could be caught out doing environmental damage. You could have a story running around fraud. You could be missing financial targets. You could have a data breach. You could have some cases with unethical behavior and lack of transparency. You could have a product defect and a recall, or you can have massive turnover of staff and strikes and protests. They're all negative. We don't want any of them. But from a managerial point of view, you're going to have to say, well, which one is the most dangerous? Because in a finite environment of money, you're going to have to put your money and your investments where it's going to hurt you the most. Now, how would you assess which of these has the biggest impact on reputation? And today, it's very much about professionals like yourself sitting around a table saying, well, based on my experience, I think this one is more dangerous than that one. And in today's world where perceptions are changing so fast, we don't believe that that's the right way to do it. You need to have some data to back up your decisions. So what we're doing is we're basically assessing each of these issues on 3 KPIs. Number one, if it happened, to what extent would it change people's perception of your company? So that's your reputation damage. So item 1 will lose 10% of reputation, item 2, 15% of reputation, etc. Number 2, if it happens, how much of your business support will go away? So in terms of how many people would now not buy your products, how many would not recommend you to others? And the third KPI is which of the 7 drivers of reputation are going to be impacted? And you need to know that in order to prepare for your crisis management. So those are the 3 KPIs we want to assess every issue with in order to be able to give you the quantifiable measure on each of these issues, which will now allow you to recategorize the issues inside the enterprise risk management grid, adding in the reputation multiplier. So let me show you the results of a global study we've done so that you can actually start getting some data. So what this is showing you is across more than 500 different companies around more than 15 countries. So it's cross industry, cross countries of those 7 issues, impact on reputation. What this tells you that with the general public, data privacy issues is the #1 risk. If companies are seeing those, they will lose on average 19% of their reputation. So having a data privacy issue is going to remove 19% of your reputation. Missing financial targets is going to remove 10% of your reputation. So again, all of them are negative, but it's double the impact on data privacy versus missing financial targets. Now you can start quantifying the impact on reputation, saying, okay, data privacy issues, not only will they cost whatever the cost in fines or downtime if you lose that, but you're also going to be facing a reputation loss of 19%, which will then trigger all these other impacts. So this is the first level of saying, let's quantify the impact on reputation depending on the issue. And the way we've done that, we basically ran ratings on these companies, exposing people saying, okay, assume company A has this data privacy issue. Now rate the company in terms of reputation and support. And that's how we calculate the data. So it's a classic scenario approach. But let's take a look on a real case. This is Facebook. So this is the reputation of Facebook in the US with the US general public from 2018 to 2019. In that time span, if you can remember, you had the Cambridge Analytica, you had Mark Zuckerberg in front of Congress, you had a number of other issues, which basically you would argue is a risk to the reputation. Now the question is, how big of a risk is it? And here's the data. So in 2018, Facebook had a reputation of 55.5 with the US general public as measured on that scale from 0 to 100. Over the course of that year, Facebook lost another 10 points in reputation, taking their reputation to 45. Now that's a scale from 0 to 100. 80 is excellent, 62 is average, below 50 is poor to weak. So reputation is sliding down into a poor level. If you look at the 7 dimensions and the 7 drivers, you can see that governance, so the perception of whether or not Facebook is open, honest, ethical in the way they do business, is the one that takes the biggest hit. They lose 47% of people's perception on that. Of course, because it's tied to selling my private data and not being open and honest about what they're doing. So that's really where people are losing the trust of Facebook. It's followed by citizenship, governance, and leadership. And those are the 4 dimensions that really takes the biggest hit. If you then look at the business impact, you can see that people's willingness to buy and recommend Facebook products moved from 32 to 24%. So a loss of 7.8 percentage points in terms of the US general public who would be willing to recommend and buy the products of Facebook. Trust and give them the benefit of the doubt goes down from 26 to 21%, and willingness to work and invest in the company goes down with 7 percentage points. So now you're quantifying being seen as someone who is not open and honest about data security, triggers all these events. And that's how you can quantify, because that was one issue, but you can have 10 other issues. You do the same calculation and it will help you prioritize the ones that from a business point of view would actually be most dangerous. When you think about your own company, you need to understand your industry, because where you operate will also impact the severity of the same risk. So just because you saw a Facebook case here, and I'll show you a few examples more, take your own industry into consideration. In every industry, there are different expectations. The 7 drivers mean different things. So you need to understand your own environment, your own stakeholders, and then you can take a look at the specific impact in your industry. And when you do it at an international level, you also need to factor in that a certain issue in Europe would be seen differently in the Americas, which would be seen differently in Asia Pac. So there are differences around the world. But the good news is you can have the data. So if you are a multinational company, you can actually map out the impact and the severity, meaning that one risk might be a high risk in one region of the world, but it might not be something you want to deal with in the other parts of that. Just to illustrate this with other examples here, you can see here that, oops, sorry. Samsung, if we look at data privacy, and again, this hasn't happened. So this is scenario building, right? So I'm just saying that if Samsung has a data privacy issue at a global level, this is global data, they would lose 25% of their reputation. Right? So Samsung today has a strong reputation of 77.3. With a data privacy issue, Samsung would lose 25% of that reputation. Now, what would that do for Samsung? Outside of losing reputation, you can see that people's willingness to buy the products of Samsung would significantly drop down. Today, 63% of the consumers worldwide are willing to buy the products of Samsung. If there is a big data privacy issue, that number goes down to 44%. Now, what is that going to do to the market share of Samsung? What is that going to do to the ability to charge a premium? Of course, that's going to put pressure on Samsung from a business point of view, which will trigger into loss of sales, loss of market share. Benefit of the doubt. If Samsung has a problem, would you give them the benefit of the doubt? That is going to drop down with 9 percentage points. Coca-Cola company, if they have an issue with local communities, so now a different issue, right? Local community is a key driver of reputation for the Coca-Cola company, because if they are seen having an issue with that one, they're going to lose 23% of their reputation, and willingness to buy their products are going to go down with 11 points. Willingness to give the benefit of the doubt is going to go down with 5 points. And Santander, which is a bank, missing financial targets, well, that's actually important for a bank. So their risk is highly, 24% of their reputation is going to go down if they are seen as missing financial targets, because that's our expectations to a bank. That's going to trickle into 17 percentage points loss of willing to do business with them and giving them the benefit of the doubt. So these are examples, and what I want to share with you is that you can quantify the impact of issues on reputation and business. And I think that's a key challenge we've seen, because we've heard, well, you can't quantify it, so therefore we can't manage it proactively. Well, that's not true. You can definitely quantify reputation if you have a model by which you can do the measurement. You can link it to financial impact by understanding how people's perception of you leads and drives their behavior, willingness to buy, willingness to work for, willingness to recommend. So having this, you will be able to quantify it and actually calculate the reputation multiplier. Okay, so now we know how to define reputation, we know how to measure it, and we can actually calculate the reputation multiplier. Now, how do we work with this? That was the fourth challenge of saying, well, there's a strategic thinking, there's some operational thinking, there's tactical. And many of the people we spoke to complain, if you will, that they don't have time for the strategic and the operational because they're dealing with crisis management. They're putting out fires all the time. Let me show you how we actually do that. So think about reputation risk management in these four variables. There is one is more the operational, saying, okay, the readiness. How ready are we to even see this? Do we have the structures? And then how do we then assess the impact, the mitigation, and the development over time? On the readiness side, this is more of a governance perspective of saying, well, have we set up the right structure? Do we even have the structure to identify, to measure, to organize, and to manage these risks? So that's applying a lot of the frameworks that I just went out and say, okay, do we have a defined process for identifying risks we're facing? Can we measure the impact on that? Do we know who's responsible for dealing with which aspect of this? And do we have a formal process for handling a crisis if it happens? So that's what we call the readiness of reputation. The next aspect has to do with the impact, the mitigation, and the monitoring of it. So how likely is it that this risk will happen? And if it happens, how will it impact us? So what's the impact? The mitigation, okay, if it happens, how much will it cost? That means that, okay, we need to prioritize these top 10. What are the things we need to do to stop it? And then how do we then constantly monitor what's going on over time? We follow a simple process for reputational risk, which is very similar to the standard risk approach. Number one, we map out the issues. So what are the issues? How do we see them from a reputation point of view? We then go out and measure. Yeah, we want to do the scenario planning that I just showed for Samsung, for Santander, for the Coca-Cola company, of saying, okay, if this were to happen, how would that impact our reputation? How would it impact our people's willingness to buy and recommend us? Then you can prioritize the risks, because now you've actually assessed them from a reputation point of view, and that's where they're going to change spots. Instead of being number 32, that risk might be number 3 because of the reputation multiplier. When you know that, then you can do the mitigation plan and you can track over time. So we start off, and you should start off with your own enterprise risk management grid. You have all the different issues and touch points. Then you put them through a reputation lens of saying, okay, let's take those top 50, because those are the ones you know the likelihood is high and the financial cost would also be high. Run them through a RepTrak assessment to basically identify the reputation multiplier, right? So that were the 3 KPIs I talked about. If it happened, to what extent is it going to impact reputation? To what degree is it going to hurt our business in terms of willingness to buy, recommend, work for, and which of the 7 drivers of reputation are going to be impacted? That is going to help you understand the assessment of each of these issues and put them in a reputation risk category. When you have that, you can prioritize the top 10, the top 15, the top 20, and then you can actually start saying, okay, we have to do a crisis communication plan for those. And that means that now that we know that if issue number 1 happens, product recall, it's going to trigger these emotions from our consumers. That means that we have to have proof points on these specific attributes, these specific drivers. And again, this hasn't happened yet. So you're trying to build your insurance, if you will, around perception of good product quality, so that if you have the product recall, people will be more likely to say, well, I would actually trust them to do the right thing, so let me give them the benefit of the doubt. But this is how This data will inform your crisis communication and risk management so that you can have mitigation strategies with the right talking points, proof points, but also the right people ready to actually address this. So that gets me to the final point, which is the ownership. And we've had a lot of conversations, and there was some frustration inside companies where you have corporate communication, public affairs saying, well, we own reputation and therefore we're the one driving it, but we're not being called upon until after the fact, and then we're dealt with a crisis management situation. Or you'll have the chief risk officer saying, well, we own all the risk and therefore we also own reputation. So we'll assess it, and only if it happens, we'll call in the PR comms people. Or the executive team saying, well, we own everything we do, so therefore we own the reputation, but we don't necessarily have all the tools to do it. So that's a classic conversation. And the question is, where is the responsibility and where's the ownership? Is it with the CEO, because the CEO owns everything the company does and the reputation is the sum of it, so therefore it's she or he who owns it? No, it's corporate communication because they own PR and marketing, and reputation is around the media. No, it's marketing because it's around our corporate brand, our product brands, our customers. No, it's a CFO because reputation is intangible value and it's linked to our stock price, so they need to own it. No, it's the chief risk officer because reputation is valuable and therefore it's a risk. No, it's everyone, depending on the topic. And you can imagine classical, if no one owns it, then no one's going to do it. If we all own it, then also no one's going to do it. So how do you actually do this? So this is our point of view on this. Basically, there are 3 levels of ownership and accountability. There is the strategic ownership, the tactical ownership, and the operational ownership. And reputation is not owned by one person or department, but it needs to have a common framework, and you need to have a conductor. So at the strategic level, yes, it is the CEO and the executive team. They need to know whatever their strategy is impacts reputation. They need to be made aware of the consequences of what they're doing. And within the executive team, our recommendation is to basically set up a reputational committee dealing with the upside and the downside of reputation. Then you have alignment in the executive team on that. Then you need a tactical owner. And there are basically 2 sides to the tactical owner, the chief communication officer and the chief risk officer, because reputation has an upside and a downside risk. There's the upside of if you improve reputation, you're going to get more support, but there's also the downside risk, which is more in the risk area. So they are responsible for directing and facilitating, implementing the data, implementing the processes. And then at the day-to-day level, it is actually the responsibility of the business leaders. So if you have a country manager, he or she is responsible for building reputation with the stakeholders in that country. If you have HR, they are responsible for building trust with employees and talent. So you push down the responsibility for building trust with the right stakeholders in the right market or with the right function. But that's really orchestrated, and that's why we use this metaphor of the conductor, because reputational risk it can be managed proactively, but you need the data and the insights to do it. And it's a cross-functional task, not owned by one team or function, but you'll only get the band to play together if you have a clear system and a conductor, and that's where the chief communication officer, public affairs, and the risk team needs to work together to get the whole company to play intact and using the same nodes in order to play from. And that is the answer to basically the ownership, right? So what we're seeing is there are way too many silos right now, people fighting over this. We think that if you go through the definition, the business, it's going to bring everyone around the table because we're all trying to do the right thing and the same thing, which is improving the business of the company. So that was the quick run through of how we see reputational risk management. I laid out the 5 challenges. Hopefully I've given you some food for thought and some inspiration in terms of addressing these 5 challenges. And with the RepTrak reputation risk approach, you will get a clear definition, an agreed standard for how to measure it, a clear categorization of reputation risk as a consequential risk, meaning that it is something that happens because something else happens, but you can quantify the impact. Data to identify the reputation risk multiplier, so that you can actually get clear data, so you can make an informed decision, not just based on a gut feeling around the table, but actually based on data saying if number 3 happens, it's going to have a bigger impact than number 2 and number 10. A framework for linking the strategic, the operational, and the tactical aspect, and then a clear and agreed ownership between the different functions, but also the different parts of the organization. And with that, you will be able to manage reputation, and you will also be able to have a meaningful conversation with your colleagues in order to understand how that actually happens. So I see that there are some questions. Let me just take a look. One question is about the ownership. Agree with the ownership point. I work a lot with risk management and I can't think beyond identification. Also, operational people only want to deal with a CEO. Comms is often left to fight the fire once it is lit. The fire once it lit, where the best framework for integrating the views of the overlapping ownership when it comes to mitigation, managing reputation, avoiding the fire. Great question, great point. And this is the point of saying, you know, you could have called me before the fire, right? So had we known this ahead of time, we could have worked together on it. And I think it's really about getting the data. The data is the best way of aligning people around it and making sure you're not just left with the fire, because then you're being pushed into the tactical putting up the fire. And reputation risk management is not the same as crisis management. Reputation risk management is putting up the smoke detectors so that you actually know what's going on. If you have a fire, you're going to call the fire brigade. So I also want to caution everyone from trying to use crisis management tools on reputation risk management, because it's 2 different things. You have a smoke detector or a fire hose. Those are 2 different things. So for this question, I would recommend actually walking through these 5 steps, getting the right people around the table, and then actually having that conversation, because that's going to clarify where the overlaps are and hopefully make everyone realize that they don't own it themselves, but it's a joint ownership. Then a question on, have RepTrak been approached with the COVID crisis? Yes, we're doing constant tracking on COVID. Interesting to see, one note on that is that what's going on with the COVID is actually the risk scenario for anything related to your workplace and your employees has gone through the roof. So workplace as a driver was, you know, not the most important driver for people. Because of COVID, because of the attention to your people, that is now the number 1 risk or number 2 risk. Meaning, if you are seen as not taking care of your people, that's going to hurt your reputation much more now than it was before COVID. So great question, and great point that you need to understand the environment you're operating in and how the drivers change, because that's going to change the multiplier on issues. That's why you can't just do one risk map and think that's it, because with the changing environment, the impact on a certain issue might be low today, might be very high in a month. Another question, after reputation risk management well done, there's any recovery plans or strategy for the company? So can you share best practice? Yes. So when you apply this, and the beautiful thing of this is that the companies who've done it, it just becomes part of the way they work. And you know, with good reputation risk management, it never happened, right? So it's always the executive saying, oh, well, we didn't get any return on investment because I didn't see any fires. So the recovery strategy and plans for the companies, yes, plenty of those, and happy to share that specifically. And you can go online. Let me just share here. Go to RepTrak.com and you can sign up and you can get access to best practices. And someone also asked about the slides and the recordings, and I believe that those are going to be made available as well. And last question here before we wrap up is, how do you work out the multiplier? Good question. The multiplier means that if this were to happen, this issue number 1, to what extent would it reduce the perception with your company? We do that through scenario testing. When you have the scenario A versus B, then you can do the multiplier between the two. And then you can say, okay, and if that happens, how less likely are they to buy your products or recommend you? And that's your gap. So the multiplier is a data-driven approach, which I'm sure you all know from a scenario planning. We just do it at big data scale, which will give you enough data to make sound decisions on, so that you can actually make the right decisions. So time is up. Thank you so much for your great questions and your attention.
Just before we go, I can say thank you to Casper. Thank you for everyone turning up today. I just had 2 quick points. And you know, like so the RepTrak company, we've got an online platform which allows people to plot, track, and manage the reputation, corporate reputation, ESG. If this has piqued your interest and you'd like to have a demo of that, I'd happily organise something with you afterwards. We've also done a UK study for what the general public in the UK expect from companies, corporate communications, marketing, PR teams moving forward for the next couple of weeks. So if you'd like me to walk through that with you directly, I can do. So if you want to reach me at jgreen@reptrak.com, I'll send the information out afterwards. And I just want to say thank you to Casper, and that was a brilliant presentation. So thank you.
Take care. Thank you so much.
Bye-bye. Bye-bye.